For the last 2 years, the market has felt almost untouchable. Every earnings season delivers another trillion-dollar headline. AI is supposedly rewriting the economy in real time. Chip companies are exploding in value faster than entire industrial sectors. Startups with barely any revenue are raising billions. And everywhere you look, the same message repeats. This is the beginning of a new era. Maybe it is. But if you've studied financial bubbles long enough, you start recognizing a very specific smell in the air. Not optimism, but circularity. Because underneath the excitement, something strange starts appearing in the balance sheets. The same money keeps showing up over and over again. A major tech company invests billions into an AI startup. That startup immediately uses the capital to buy cloud infrastructure and hardware from the same major tech company that funded it in the first place. Revenue gets booked, demand looks explosive, analysts upgrade forecasts, the market cap rises. But when you zoom out, very little new money actually entered the system. It just moved in a circle. And if that sounds familiar, it should. During the late stages of the dot-com bubble, telecom firms and tech companies used remarkably similar structures. Companies financed customers so customers could keep buying their equipment. On paper, it looked like unstoppable growth. In reality, many businesses were quietly manufacturing their own demand. Right before the collapse, the numbers looked strongest. That's the uncomfortable part. Because today's AI boom may not just be a technology story. It may also be a financing story disguised as innovation. And eventually, every financing story runs into the same problem. Reality has to pay for it.
To understand what's happening inside the AI boom, you have to stop looking at the headlines and start following the cash. Because the public narrative is straightforward. Demand for artificial intelligence is exploding organically. Startups need computing power. Enterprises are racing to integrate AI tools. Cloud revenue is soaring because the world suddenly discovered a revolutionary technology. And part of that is true. But there's another layer underneath it, one that looks far less like organic demand and far more like a closed financial loop. In finance, there's a term for this: round-tripping. At its simplest, round-tripping is when money leaves one entity, passes through another, and ultimately returns close to where it started, while creating the appearance of legitimate economic activity along the way. The AI ecosystem has developed a version of this dynamic. A large technology company invests billions into an AI startup, sometimes through direct equity investment, sometimes through strategic partnerships, cloud credits, preferred financing structures, or venture allocations. Publicly, it's framed as accelerating innovation. But then the startup takes that capital and spends enormous portions of it on GPU clusters, cloud contracts, storage, and compute capacity, often from the exact same company that funded it. The money comes back. Not always dollar for dollar, not immediately, but structurally, the loop matters more than the timing. Because from the outside, it creates an incredibly powerful illusion: massive, independent demand. Cloud divisions report explosive growth. Hardware orders surge. Data center expansion accelerates. Analysts model future adoption curves based on that demand. Investors extrapolate those projections outward, assuming they represent broad-based economic transformation. But some of the buying pressure is internally stimulated, and that distinction matters enormously. Imagine a bank lending money to consumers specifically so they can continue purchasing the bank's own financial products. Technically, revenue exists, transactions occurred, but the health of the system now depends on continued financing, not sustainable end-user economics. That's the vulnerability. Because if financing slows, demand can evaporate much faster than expected.
We've seen versions of this before. During the late 1990s telecom boom, infrastructure companies extended aggressive financing to telecom operators so those operators could keep buying networking equipment. It created the appearance of endless growth in internet infrastructure demand, but much of that expansion was debt-fueled and internally reinforced. When capital markets tightened, the entire structure suddenly looked fragile. The same thing happened in other bubbles too. Housing booms often feed on increasingly easy credit. Auto markets sometimes rely on extended financing terms to sustain sales volume. The underlying pattern is always similar. Demand becomes partially dependent on the financing mechanism itself. And AI may be entering that territory. Because the economics are brutal. Training advanced AI models requires extraordinary amounts of compute power. The infrastructure costs are staggering. Many startups generating headlines today are deeply unprofitable and cash-consumptive. On a standalone basis, very few could afford the scale of hardware they're currently using without external capital injections. So, the ecosystem keeps feeding itself. Investments justify hardware purchases. Hardware purchases justify valuation growth. Valuation growth attracts more investment. And rising stock prices reinforce the narrative that the demand must be real because the market says it is. This is where bubbles become difficult to recognize from the inside. The system produces visible activity. Revenues are technically real. Growth rates look extraordinary. But the quality of that growth becomes increasingly dependent on continued liquidity and confidence. Not unlike a flywheel that only spins as long as external energy keeps being added. And once markets start questioning whether the demand is truly independent or merely subsidized by the giants themselves, the perception changes very quickly. Because investors stop asking, how fast is AI growing, and start asking a much dangerous question. How much of this demand would still exist without the financing? But the financing loop is only one layer of the story. The second layer is quieter, far more technical, and arguably even more important because it directly affects reported profits. Not revenue, profits. And it revolves around a deceptively boring accounting concept, depreciation. Most people hear that word and mentally tune out, but depreciation is one of the most powerful tools corporations have for shaping how healthy they appear financially, especially in capital-intensive industries like AI infrastructure. Here's the simple version. When a company buys expensive hardware, servers, GPUs, networking systems, cooling equipment, it usually doesn't count the entire cost as an immediate expense. Instead, accounting rules allow the company to spread that cost over the useful life of the asset. So if a data center server costs $100 million and management says it will remain useful for 5 years, the company may record only $20 million of expense per year. That sounds reasonable until you look at AI hardware. Because in the AI race, hardware becomes obsolete incredibly fast, faster than most traditional enterprise infrastructure cycles. A cutting-edge GPU purchased today may be economically outclassed within just a few years as newer architectures deliver dramatically better performance and efficiency. Physically, the machine still works. Economically, it may already be old. And that distinction creates an opportunity. If a company decides to extend the estimated useful life of its servers from, say, 4 years to 6 years, annual depreciation expense immediately falls. Nothing changed physically. The hardware didn't become newer. But on paper, profits suddenly improve because expenses are now spread over a longer period. A small accounting adjustment can create billions in additional reported earnings. That's the arbitrage. And during euphoric periods, markets often reward these changes instead of questioning them. Margins expand, earnings per share rise, analysts revise targets upward. The company appears more efficient and more profitable, even if the underlying assets are aging faster than the accounting implies. That becomes especially dangerous in AI because the industry itself is driven by relentless performance escalation. The pressure to upgrade is constant. A model that required thousands of GPUs last year may now require entirely different chip architectures to remain competitive. Energy efficiency standards shift, cooling demands change, software frameworks evolve around newer hardware capabilities. In practice, many systems are economically outdated long before their accounting life ends. But balance sheets smooth over that decay. And smoothing matters because valuation multiples in technology are heavily tied to future profitability assumptions. If reported earnings increase, even through accounting treatment rather than operational improvement, market capitalization can rise dramatically. The incentives are obvious. Management wants stable margins. Investors want expanding profits. Analysts want the growth narrative to continue. So extending asset lives becomes incredibly attractive. To be clear, this isn't necessarily fraud. Companies are allowed discretion in estimating useful life assumptions. The problem is that during speculative booms, those assumptions often drift towards optimism at the exact moment technological reality is accelerating in the opposite direction. That gap is where phantom profitability emerges. Because eventually the physical world catches up. Servers still need replacing. Data centers still require capital expenditure. Cooling systems still age. Hardware efficiency still deteriorates relative to newer generations. And when replacement cycles compress unexpectedly, the accounting illusion starts reversing. Expenses surge back. Margins tighten. Free cash flow weakens. Suddenly, a business that looked extraordinarily profitable begins consuming capital far faster than investors anticipated. And once the market realizes prior earnings were partially supported by depreciation assumptions rather than durable economics, confidence can shift violently. This is one of the oldest patterns in financial history. Boom periods encourage optimistic accounting because optimism itself becomes profitable. The stronger the narrative, the less incentive anyone has to challenge the assumptions underneath it, until growth slows. Then every hidden fragility surfaces at once. And in the AI boom, one of the biggest fragilities may be sitting quietly inside the depreciation schedules of the very companies investors believe are unstoppable.
Up to this point, the AI boom still sounds like a financial problem. Circular funding, accounting adjustments, inflated demand signals. But underneath all of it sits a constraint that accounting cannot smooth over and capital markets cannot hype away: electricity. Because artificial intelligence, despite being sold as software, is ultimately a physical industrial system. Every model, every chatbot, every generated image depends on enormous amounts of computation happening inside very real buildings filled with very real machines consuming very real power. And the scale of that power demand is becoming difficult to hide. Modern AI data centers are nothing like the server farms of a decade ago. These facilities operate closer to industrial infrastructure than traditional tech campuses. Massive GPU clusters run continuously at extremely high utilization rates. The chips generate extraordinary heat, requiring equally enormous cooling systems just to remain operational. Which means AI doesn't just consume computing power. It consumes electricity twice, once for computation and again for cooling. And this is where the narrative starts colliding with physics. Because software can scale exponentially. Power grids cannot. Building new generation capacity takes years. Expanding transmission infrastructure takes years. Manufacturing transformers takes years. Permitting alone can take years. Meanwhile, AI demand projections are growing quarter by quarter, sometimes month by month, as if the physical backbone supporting it can simply materialize on command. It can't. Across multiple regions, utilities and infrastructure operators are already warning about strain. Some hyperscale data center projects are facing delays not because companies lack money, but because local grids physically cannot supply enough power fast enough. In certain areas, developers are effectively competing with residential and industrial consumers for electricity access. That changes the economics dramatically.
Because once energy becomes the bottleneck, the entire AI expansion story becomes more capital-intensive than investors expect. Companies aren't just buying ships anymore. They're indirectly financing substations, transmission upgrades, backup generation systems, cooling infrastructure, and land positioned near stable power availability. The hidden cost of AI isn't software, it's energy infrastructure. And energy infrastructure is slow. This is why the market may be underestimating future capital expenditure requirements. Investors often imagine AI scaling like previous internet businesses where software distribution costs declined over time. But advanced AI systems don't behave like lightweight software platforms. They resemble industrial operations with escalating physical requirements. More users require more inference compute. More inference compute requires more servers. More servers require more electricity. And more electricity requires entirely new layers of infrastructure the public rarely thinks about. There's also a second-order effect developing. As electricity demand rises sharply around concentrated data center hubs, utility costs can rise for everyone else. Local grids experience stress. Communities begin pushing back against large projects consuming disproportionate resources. Environmental tensions increase. Political scrutiny follows. And once politics enters the equation, growth assumptions become much harder to model. Because now the constraint is no longer technological, it's societal. This is the part of the AI narrative that feels strangely disconnected from reality. Markets are pricing the sector as though intelligence itself is infinitely scalable. But intelligence, in machine form, is tied directly to energy conversion. The models do not exist independently from the physical systems feeding them. Every token generated has a wattage cost. Every breakthrough requires infrastructure underneath it. And infrastructure obeys physical limits. That doesn't mean AI disappears. It doesn't mean the technology is fake. In fact, the technology may be genuinely transformative over the long run. But bubbles often form around real technologies. Railroads were real. The internet was real. Telecommunications infrastructure was real. The problem is that financial markets consistently underestimate the gap between technological possibility and physical scalability, especially when liquidity is abundant. Right now, the AI boom is being valued as though compute capacity can expand endlessly and instantly. But the deeper you examine the system, the more obvious the bottleneck becomes. Not chips, not software, not even financing, power. And when a boom built on exponential expectations collides with infrastructure that expands linearly, something eventually has to slow down. The only question is whether markets realize it gradually or all at once.
One of the strangest features of every major bubble is that public enthusiasm and private behavior often move in opposite directions. The headlines stay euphoric, the conferences stay optimistic. Executives go on television talking about transformation, disruption, unlimited opportunity. And quietly, in the background, shares start getting sold. Not all at once, that would trigger panic. Smart money almost never exits dramatically. It exits methodically while liquidity is strongest and public demand is still enthusiastic enough to absorb supply without questioning it. That's the important distinction. Sophisticated capital doesn't wait for certainty that a bubble has peaked. It reduces exposure when the risk-reward balance stops making sense. And during speculative booms, that usually happens long before the public narrative changes. You can see the pattern repeatedly throughout financial history. Near the late stages of the dot-com era, insiders sold aggressively into strength, while retail participation accelerated. During the housing bubble, institutional players began reducing exposure to mortgage-linked assets, even as public confidence remained extremely high. The behavior wasn't mysterious, it was structural. Insiders understand liquidity better than almost anyone else. They know exiting is easiest when buyers are still optimistic. Once sentiment cracks, the exit doors narrow very quickly.
And parts of the AI boom are beginning to show similar characteristics. Executive stock sales have increased across portions of the technology sector. Early investors continue distributing shares through secondary offerings and private placements. Some hedge funds that publicly praise the long-term AI narrative are simultaneously rotating portions of capital into less crowded sectors with stronger cash flow stability. Again, this doesn't mean they believe AI is worthless. That's an important nuance. Sophisticated investors often separate technological belief from valuation discipline. They may fully believe artificial intelligence will reshape industries over the next decade, while also believing current pricing assumptions are unsustainably aggressive. Those are not contradictory positions. But to maintain the boom, the public narrative has to remain overwhelmingly positive, because once investors start questioning the quality of demand, the accounting assumptions, or the infrastructure constraints underneath the story, multiples can compress extremely fast. And valuation compression in highly concentrated sectors becomes dangerous because passive money flows amplified the rise on the way up. The same mechanism can accelerate declines. This is why late-stage bubbles often sound loudest near the top. Optimism becomes self-reinforcing. Media coverage intensifies because rising prices attract attention, and rising attention attracts more capital. But underneath the excitement, positioning quietly changes. The strongest hands become more cautious. The loudest voices often have the least flexibility. And historically, by the time retail investors feel absolute certainty about a sector's future, much of the asymmetric opportunity has already disappeared.
So, where does this leave investors? If the AI boom contains circular financing, aggressive accounting assumptions, infrastructure bottlenecks, and increasingly crowded positioning, the answer probably isn't blind pessimism. Technological revolutions are real. Some companies will survive this cycle and become enormously important. But survival and valuation are not the same thing. That distinction matters. Because markets tend to overpay for narratives during periods of excitement and underpay for boring systems that quietly generate durable cash flow underneath the economy. And right now, much of the market is concentrated in a very narrow idea of growth. The alternative is not avoiding technology entirely, it's widening the lens. Instead of asking which company has the most exciting AI model, you start asking more grounded questions. Which businesses generate reliable cash flow regardless of hype cycles? Which sectors benefit from physical necessity rather than speculative expectations? Which assets become more valuable when the real economy, not just financial sentiment, tightens? That framework shifts attention toward tangible infrastructure, utilities, energy transmission, industrial logistics, pipeline networks, electricity generation, and physical maintenance rather than pure narrative expansion. Not because they're glamorous, precisely because they aren't. Historically, some of the most resilient long-term investments emerge from sectors the market temporarily ignores while chasing transformational stories elsewhere. These businesses often grow slower, but their economics are easier to verify because they're tied to things the world physically requires: power, transportation, maintenance, flow. And maybe that's the deeper lesson underneath every bubble. Financial markets can stretch narratives very far for very long periods of time. They can reprice expectations almost infinitely upward as long as liquidity and belief continue reinforcing each other. But eventually, every story collides with something tangible: cash flow, energy, debt servicing, physical constraints. Reality doesn't move as fast as hype, and when the gap between the two becomes too large, markets don't correct gently. They reset.